All right. Hidden AI winners, TrumpRx coming to a pharmacy near you, and is private equity set up for a big slide? This is Curia's third live stream, and I am joined by Simon Erickson of Seven Investing and Eoin Treacy of Fuller Treacy Money. And fun fact, both of those guys are in Texas. Just what it is. So first story, Simon, talking about AI and AI's hidden winners. We're in fact trying a little segment on this. It's going to be kind of an extended thing we'll do. Simon, 95% of generative AI pilot programs at companies are failing per an MIT NANDA study. NANDA is like their lab that studies this. And apparently the 95% are failing largely because of friction, cultural friction. I don't know if that's absolving the technology or not, but ChatGPT use has leveled off. AI generation, AI image generation is way down. And while it's above my pay grade to pick ultimate winners, you've got like 6 big companies battling it out for a situation that might produce 1 or 2 big winners. So there may be a way to sidestep this. Now, you're going to lead us into sort of a backdoor angle, as I understand, something that we'll explore in this multi-part series we'll call AI's hidden winners. Can you explain the logic and then a company that you like?
Yeah, James, my goodness. First of all, there is a lot to unpack in everything going on in AI right now. But I think we can agree that the headlines are pretty much being dominated by the companies at the top there, right? OpenAI has become part of our everyday conversation. It's almost in all of the biggest and most read headlines of the financial media right now. And yet this is a privately held company. It's got about 7,000 employees, but it has a $500 billion valuation. And it continues to work the angles of getting more and more partners and big deals done, which is why it's making so many headlines. In fact, just this morning, James, before we even had time to fully digest what's happening, just this morning, we saw OpenAI sign a new deal with AMD, where AMD is going to be providing up to 6 gigawatts of its computing chips to OpenAI for its data centers, of course, to power them AI models over the next several years. So things like that, you kind of break down the math on this, of what an AMD chip is doing right now versus how much this is. This is worth $180 billion of revenue to AMD by my calculation. So, for good reason, AMD stock is up 30%. But now let's peel this back, James, because it's not just NVIDIA and AMD, the publicly traded chip companies, chip designers, or OpenAI, the privately held company worth $500 billion right now, that is going to win from the build out of the data center. I wanted to kind of start a new segment that we're going to talk about here, that if you wanted to invest in AI, you want to make money off of this trend, but maybe you think it's a little too late to buy into NVIDIA or AMD or these other massive companies. Where are the hidden winners? Where are the companies that are actually going to make a ton of money off of this that you might be considering worth investing in?
Absolutely. I mean, it sounds great. And for someone like me, I mean, I might take a flyer on a few risky stocks, but maybe people watching have a lower risk tolerance and they want to get into AI, but they don't want to be gambling on who's going to be ultimate winner. They're looking for more of a picks and shovels play, right?
Yeah, absolutely. James, we might
have a graphic, by the way. You want me to show this graphic on the screen? Yeah. Okay. Let me
show it up just to show the magnitude of what we're talking about here right now, because the size of a large data center is typically reported in terms of the power that it consumes. We used to kind of get used to large data centers being 500 megawatts, half a gig. And we've transitioned to now talking in the gigawatt age of gigawatt-sized data centers. I have some trivia for you, James, or for Eoin. We didn't talk about this before the show, but I did want to ask you guys, just for the fun of it, where in the United States is the largest nuclear power plant located?
I think it's in like Tennessee or somewhere like that.
James, yeah, somewhere in the South. That's all I know. Somewhere in the South. They're more friendly to that kind of thing.
You guys are both correct. It is in the Southeast. It's actually in Georgia. The world's largest nuclear power plant is in Georgia. It has a combined output of all of its generators of 4.5 gigawatts. That is the largest nuclear power plant we have in America right now. And yet we've just now seen Meta announce that it's going to produce a 5 gigawatt data center, larger than the largest nuclear power plant in America could independently provide enough power for.
That's amazing.
Just to show you the
Yeah.
magnitude of what we're talking here, it's massive. And so we have this graphic here that hopefully people that are watching live can see. Of,
And this is from Bank of America Global Research, I
correct.
believe.
Yep. Thanks, James, for your point. It's like Bank of America research, but it kind of shows, in 2025, the average CapEx cost in terms of all the equipment required for a data center is about $40 billion per gigawatt. And we've transitioned from talking half a gigawatt to now a full gigawatt to now 5 gigawatts. So depending on the size of the data center, multiply these accordingly. But you can kind of see it's not just the servers and the computing chips that are made, by the NVIDIAs and the AMDs of the world. There's a lot of other things that are involved in this: cooling towers, chillers, the networking equipment themselves, the computer room air handlers, things like the generators for the power. There's kind of a lot of different components that this is a rising tide that's going to rise a lot of boats. And a lot of these companies that we just kind of dismissed as boring industrial companies that were growing at 5 or 7% annually, they're making a ton of money right now, James.
Amazing. Yeah. And it's amazing how these data centers are like the hair dryers of the US. Someone turns on the hair dryer and it dims the lights in the house. Like, it's just the amount of power they're sucking up is just mind blowing. And yeah, that has to be built, that has to be maintained, that has to be cooled. There's all these little boring things that frankly need to be done regardless of who wins the AI race, right?
Yeah, and I just wanted to highlight one of them. I don't want to spend the entire show on this because we've got a lot to talk about, but just to kind of talk in the magnitude of what if we could put the graphic up just one more second,
Oh,
James.
sure. Yeah. Okay. 1 second.
Just to show at the bottom of the graphic here, there was something that was called CRAH. If you saw it at the bottom of the graphic, we'll pull it back up here again. You see the CRAH is at the bottom. That stands for computer room air handlers. And you see it's, about, call it $600 million per gigawatt. For a contract from a company like a Vertiv, is a company that provides these. Just to put this into context of how big of a trend this has been, Vertiv has typically grown at 7 to 8% annual for sales, right? It was benefiting from the data center trend. You have a lot of cooling fans. You need to have cooling coils. Sometimes that's liquid cooling, like liquid nitrogen and things like this. But just to put in context, typically growing at 7 to 8% per year. James, it turned heads last year in 2024 when Vertiv said we are forecasting 14% revenue growth for the fiscal year 2014. A full 50% higher than what it was typically seeing. And then it actually achieved 17% year over year growth for fiscal 2014. And James, in the most recent second quarter of 2025, the company just achieved 35% revenue growth. So this is a 5x multiplier for a business that used to be kind of sleepy, doing boring things, all of a sudden scaling the business really quickly as it can't even keep up with the amount of orders that it's getting.
That is amazing. And this was probably, I'm just opening this up now. You can see I was buying some water filters based on the ad. So look at the chart. Yeah, this guy has been kind of this sleepy little company until AI, until ChatGPT basically took off, LLMs took off. And then it's off to the races. We had a dip here. But the point, I guess, for the average listener, those growth rates for an NVIDIA, like, they sound kind of regular, but this is not an NVIDIA. This is a much more picks and shovels company. So that's why they're especially notable, especially phenomenal. In fact, I might say they pay a tiny little dividend too, it looks like.
Yep. And a data center, you have to run it at less than 70 degrees Fahrenheit. Servers run really hot. NVIDIA's got its new Blackwell chips out there. There are already complaints from data centers are running too hot. The temperatures are getting too high. And so how do you respond to that? You innovate on the liquid cooling, technologies. And a company like this, is perfect position to benefit from
and
that.
PE of 78, obviously that's high, but that means they've got E. They've got E. It's not a wildly speculative, totally unprofitable company. So Simon, if I am buying into this, and again, we're just tossing out ideas. We're not making personal investment recommendations, but if I metaphorically buy your idea, I mean, if I like this, what kind of risk return profile can I expect over the next 5 years with Vertiv?
James, you have to look at the volatility in that stock price. If you saw the peaks and the valleys of Vertiv stock, it's all around the announcements. The media catches on, and there's a new deal with AMD and OpenAI, and so they're going to have to build out 6, gigawatts of future. I mean, that's when there's a lot of optimism. You're not going to get the same return. That's why the PE is at 70x right now. But
Yeah.
if you also saw back in, earlier this year, I believe it was around March or something like that, they actually were a lot more conservative. There was tariffs talk, there was macroeconomic talk. There was kind of a little bit more pessimism in the future of the data center spend. I think that's when you want to go after an opportunity for a company like this. You pay a premium if you buy in times of optimism like that, and the same as you get a better return if you buy when there's a little bit more pessimism surrounding stock.
Wise words that apply to basically every investment, right? Economics is a social science, I like to say, and nobody can time the market perfectly, but it's always better to buy low and not just sell high, just hold. If you got a really good company, just hold. You don't have to sell it. So it sounds like this is a long-term winner. It's not a short-term trade, and if you buy it, it should be something that you're prepared to hold through those peaks and valleys because you're going to have them.
Yeah, and James, we'll be chatting quite a bit on the show, in the next couple of weeks about some of those other segments of the data center too. Vertiv, one idea of many that could benefit from this.
I'm excited about that. I was looking at water companies. I mean, I'll save more of this for future segments, but water is about as boring as it gets, right? I mean, nobody stops flushing their toilet in a recession. It's just how it is, right? It's got very, very steady demand, but it's something that we need. Our water structure in the U.S. is decrepit. It's ancient. Some municipalities still use wooden pipes like ancient Romans did, right? It's that bad. And all these data centers and all this power that needs to be built. I mean, we're having electricity load growth really for the first time in like 20 years. It's been pretty flat, and now it's finally bumping up. Like, we'll need more water, and we'll need a lot more. We'll need more labor. We'll need a lot more other things that companies like Vertiv and many others provide. So I'm just as excited as you are, Simon, about digging into this segment in future installments here, hidden AI winners. All right, so shifting gears totally, or nearly totally. If we step back, the years have given us interesting things from Donald Trump, Trump ties, Trump the game. I owned that as a youngster. Actually, one of my first business books I read was The Art of the Deal by Donald Trump. And as I don't know how old I was at the time, but I was in middle school or something in the mid 80s. It was, he seems so cool. This guy's got everything together. So I read that, I absorbed it. Maybe it was ghostwritten, I didn't know. But Trump University, we've got Trump Stakes, and now Trump Prescriptions. I'm exaggerating a little bit. Trump is not actually making the prescriptions, but he did just announce, he called the plan TrumpRx. He did just announce a program that essentially lowers the cost of pharmaceuticals to end users and makes a deal with companies that participate. At least we got one so far, Pfizer, that they get exempt from tariffs, which they like very much. Pharma stocks have jumped on this news, Eoin. Optically, it looks like a good thing. Trump has long campaigned, as have many politicians, against high drug prices in the U.S. We do pay much more than much of the rest of the world. We effectively subsidize the research for most of the rest of the world, tongue-tied today, to enjoy. So this looks on a headline like it solves that problem. But you've written about this in your newsletter, and I think there's more there. Can you help us unpack this?
Well, you got to think about it that one thing we do know about President Trump is that he loves headlines, and he loves to make headlines, and calling it TrumpRx is a big headline, and it gets everybody attached to it. And, James, the issue, of course, is what does it really do? Well, what it really does is that it's like drop shipping. You go to the TrumpRx website, it'll send you directly to the manufacturer, and then you get to buy it from the manufacturer. How many people actually do that? How many people actually buy their prescriptions net? They usually get it from their insurance company. And that obviously raises questions. How big a market is this going to be? Probably not that big a deal, but it's a big deal for the pharmaceutical companies because they might have to take a price cut on some of what they sell, and certainly not all of it. But they get a reduction on the tariff on everything that they import from around the world. So that's a massive benefit. And it also then gives a route for the other companies to follow. So you play the ball, you play ball, you follow the plan that's set out by the government, you do what they want you to do, and then everything gets better for your business. That is the route that all these other companies are going to have to take. It's only a matter of time before they figure that out. And now we're starting to see the shares start to perform. And what I like about this is that pharmaceutical companies everywhere, whether you've got the big pharma or the mid-size or the small caps, they've all been trending down. And there's two important factors there. The first is that during the election and during almost every election, politicians take pot shots at pharmaceutical companies because everybody knows that pharmaceutical prices are high and nobody likes paying for them. So they're an easy target. And that means that around elections, those shares get more volatile. Well, we don't really have another presidential election for 3 years. So they're not going to be under as much political pressure going forward for at least the next couple of years. Then, on top of that, these are highly cash generative businesses. So they invest a lot of money to build brand new products that really save lives. And that is a massive money spinner. So we have low prices, we have a political environment that's changing, and now they have greater visibility. Then the additional point is that during the pandemic, all of the money, all of the investment capital went into vaccine producers. So it was companies like the mRNA companies that were really developing these vaccines. They took all of the investment capital, and everything else, like the gene treatments and immuno-oncology treatments, they got no money. In fact, there was an ETF that was the Lungcar Immuno-Oncology or Cancer ETF. It went bust in June of this year. They could not get anyone to invest, and they couldn't justify holding on to that ETF. So now you don't have an ETF that invests in smaller caps or those that are very innovative. You've just had a massive change in how the government is going to attract interest into this sector. And now the shares are just starting to turn. And Pfizer has broken its downtrend. So I think that we are now at the beginning of a new trend in the biotech sector, a new trend in pharmaceuticals more generally. There's one other point, and it's something that institutional investors have mentioned to me on several occasions over the last 6 months. And it's that they will often see that it is biotech is one of the last movers in a big bull trend in technology. And when you start to see a loss of momentum in other parts of the tech sector, then it is biotech starts to pick up that speculative capital. So this is also a late stage mover that has potential to really outperform.
Well, a lot to unpack in that, Owen. I mean, just to sort of really simplify it for the new listener who's new to this topic, it sounds like if it weren't for the tariffs, TrumpRx would be a negative for pharma companies, right? Because 80, 85, 90%, whatever percent of the US has insurance, like those people don't really care. This is only targeting the small percent who don't. And it's sort of like an Expedia or a kayak.com or some kind of like a pass-through website that sends you to the pharma company directly. And so now they just have to sell at this lower most favored nation status price, but which is bad. In other words, they're selling for lower prices, but they're getting tariff exemption. And that's what makes all the financial difference in this. Separately, I mean, pharma and biotech are a little bit separate. So somebody's brand new to this. Pharma is the big company, it has distribution. Biotech is kind of like, if pharma is MGM or, Paramount or some big movie studio, biotechs are like the little independent movie studio that take a lot of the risk and try to find something there. And then they typically sell themselves up to the pharma companies. And I think previously, the FDA approves, I don't know, 50 or 60 new drugs a year in the US. It's not very many, but we had this huge boom years ago in biotech where thousands and thousands of drug applications, and there were literally thousands of biotechs vying for these, 50 or 60 approvals. And it just, the math wasn't going to work. We had that bust, but it sounds like you think for a number of reasons, perhaps this TrumpRx and just perhaps the way the tide is turning or the way the bull market is evolving. If we are in the tail end of this bull market, which many people think we are, it could be just a timing reason to get into biotech. Is that accurate?
Well, I think there's two additional points that are worth considering. The first is that a lot of the IPOs that are coming through now in the biotech sector are AI related. And a
Mm.
friend of mine is actually pre-IPO with his drug discovery AI model. So that's definitely something that's coming down the pipe, that it is going to be an additional play on artificial intelligence just by buying the biotech companies that are using it for drug discovery. But then, there's also the private equity element here.
Mhm.
So we have the you talk about it as a movie theaters. The way that I kind of think about the biotech sector is kind of like mining, because you have established mines that they know what they've got, they know what they can sell, they know what their production is. And then you've got people that want to raise a lot of capital, and they want to try something new, and they want to dig a hole in somewhere that's they've never dug a hole before. And if they find something, well, then that's going to be fantastic. And if they can proof it up, that's going to be even better. And then if they can get to production, it's going to be even better. And then they get to sell themselves to the big mine. And if it doesn't work at any point along the way, then your investment capital goes poof. So that's very similar to junior mining. And it's also very similar to how they go out and they try and find capital from private equity, because private equity needs to find good companies, winning companies, those that have a good business model, that have good, uh, I think, management structures, that have high probability, and then they'll invest, and then they will try to get the return for their investors. And of course, we are now going through this incredible period in private equity where there is a lot of pressure on returns. And I thought that, James, you have a lot of insight on that. I thought you might like to share what you have to say about private equity.
Yeah, yeah. Oh, and let me just I'm trying to share my screen here. Private equity, for those who are new to the space, it was kind of like it is still kind of the darling for a lot of uh, investors, in that low interest rates made private money more accessible. The graph I'm trying to show, if I sound distracted, I'm going to bring it up on the screen here. The number of public companies in the US, if you guys can see this now, has declined pretty rapidly over the years. Being public costs at least a couple $1 million a year for most companies. It's expensive. It takes a lot of time, a lot of mental energy. And if private markets can be the new public markets, there's no need for companies to go public. And we're seeing that with companies like OpenAI, Anthropic. It would be unheard of to have a $500 billion company, or very, very, very rare, to have one of the largest market cap companies in the world be private. Even 10 years ago, it was just a thing you did. It was a rite of passage to go public. That has lost a lot of its cachet. Some people might take the extreme case and say that it's only the junk, or many of the junk companies are going public because they're not good enough to get capital from sophisticated private equity investors. And so they have to go public and tap the less sophisticated retail market. I don't know that that's always true, but it may be true sometimes. But we've had, so for, the past, since COVID, at least, maybe a little before, with the low rates, you had a lot of money and a lot of brains going into private equity. It was the hot thing to do. Once you got your MBA, you try to go work at a private equity shop. That's been great, but the valuations with interest rates are arguably coming down in many cases. Some of the cachet is gone. And when people say, I want my money back, they're realizing that there's a lot less liquidity in these private markets. The public markets, it's easy to buy and sell. And the price realization, the price discovery is very accurate because you have so many transactions. A lot of private equity funds, it's like a joke valuing the business. You don't know what it's really worth because there are so few actual buyers. So long story short, if you're not invested in private markets, this probably doesn't affect you directly as much. But there are a couple of big private equity funds, and I'm trying to bring them up on the screen here. Which is Vertiv Holdings. We haven't really seen the valuations come down a lot yet. And just give me 1 second here. I'm trying to get this guy up here. Blackstone, for example, is one of the biggest. If we look at 5 year, it's still doing pretty well, but some of these companies could be in for a beating as these valuations come down, which is especially if interest rates don't go down a lot. The other thing we've seen is and this is Blackstone, just in case somebody is trying to follow at home. The other end of the spectrum is some of these crowdsourced platforms, which I would liken in some cases more to consumption or to entertainment. We could see a drop in those as well. So long story short, I mean, this is more of a reflection of the markets. I feel like it's not necessarily going to affect you if you're not invested in these companies, but I think we've had a bubble in private equity, and that bubble may now be crashing. So, Eoin, I think you've written about this and probably have something a lot smarter to say about that, but that's my quick take.
Well, I think that you have to kind of parse out how much of the return came from the expertise of the private equity people, that they go into a company, they have this management know-how that they can introduce and they can really boost margins. That's the selling point. Now, the next question is how much of it was because of low interest rates, abundant liquidity, and that they were able to buy at a favorable price? Because we don't have low interest rates any longer. And the thing that really is at the back of my mind is there's a kind of an adage in the market, and it is don't mistake a bull market for brains.
Yeah.
And we've had a massive period of time, it's just a decade, where there was exceptionally low interest rates, incredibly abundant liquidity. And it felt like every man and his dog was a new private equity manager. I mean, I look at the parents in my kids' school, how many of them are private equity managers? It was a lot, and
it sounds like your kids go to a pretty good school.
They do go to a pretty good school. But the reality is that there are more private equity companies now than there are McDonald's restaurants.
Wow. Is that a real fact?
That's a real fact. And actually,
oh
it
my
was
gosh.
publicized by KKR themselves.
Huh.
So now you have an environment where maybe not every company is going to go bust, or not every company is going to sell for its valuation. What I suspect we're going to see now is a winnowing effect. That you're just going to shake it out. You're going to get the wheat from the chaff, and the chaff is worthless. There are going to be private equity companies that paid way too much, that they are not going to be cash flow positive for those businesses, and those businesses are going to have trouble. But the ones that are successful, well, then you've got Brookfield, which is pretty much private equity royalty, talking about a 7 trillion opportunity in artificial intelligence. And they're investing in the data centers. They're basically following exactly the business model that Simon is talking about. They want to get in on the ground floor. They want to buy the infrastructure because they know that regardless of what that data center is used for, it still needs electricity.
Yep. That's probably the best. Simon, you were about to say something profound, I'm sure, too. Oh, Simon, you are on mute, it looks like. It says, heads up, Simon's track. So apologize to the audience here. We have a technical delay.
Check 1, 2.
There we go. Yeah, maybe
Okay.
this is not maybe Riverside is not using the right data center, but now he is back on and I can hear him clearly.
AI, gotta love it, right? I was going to just propose one other idea for the private markets angle, and that's BlackRock. BlackRock has made the fees very, very low for people to invest in publicly traded stocks. The iShares and the ETFs they have globally. They're very interested in private deals too. They acquired Global Infrastructure Partners for kind of infrastructure deals several years ago. They're very interested in getting the fees lower for investors to access private markets. Could be a sneaky angle to everything we're talking about as a large company really interested in this segment as well. BLK, is the ticker.
BLK right here, yeah. Market cap, $181 billion. So tiny compared to OpenAI, but big compared to most companies. PE ratio of 28, which is kind of market average, pretty reasonable there. So 1.8% dividend yield also. So I like BlackRock by the numbers already. So excellent. So speaking of this, let me stop sharing here. As we wind to a close, we like to cover some stocks that we're looking at. These are not necessarily recommendations, and in fact, mine definitely won't be a recommendation. It's just something on my dashboard here that I'm considering. And let me tap you first. So Simon, by the way, is that your stock, BlackRock, or you just kind of add that in as a bokeh? You are full of ideas then. So Eoin, why don't you go first with your stock that you're looking at that might be worth or not worth people considering in your view?
I think the one that is really piquing my interest right now is Intelia.
Hmm.
So they own the IP for CRISPR, or at least they say they do. There's always a little bit of a stress there on which company actually invented it. But they're developing new cancer drugs with their CRISPR technology. And I think that this is the end of the bear market. It has crashed in the last 3 years. It is just starting to turn around. If we're talking about buy low, sell high, well, this is low. And I think the market is turning around. So for me, that is a much more attractive proposition rather than chasing momentum right now.
I think we're moving the market, Owen. You are. It's up 5% today. So maybe people are watching this and buying very quickly. Yeah, Intelia. I actually own this stock in full disclosure. So and I bought it, years ago when it was a lot higher. So I am with you in crossing my fingers on Intelia Therapeutics. All right. Simon, what is on deck for you?
Yeah, so speaking about buy low, I also have a value idea right now, which is in the consumer discretionary retail space, James.
All right.
This is the space that's just been getting hammered. The consumer is in kind of a funk right now for various reasons, tariffs, unemployment rising, various reasons. But I think that one company that has proven it's done well and is still struggling because of the climate we're in right now is Lululemon.
Lululemon. All right.
Yeah, Lululemon, the yoga retail enthusiast, really trying to get in more into activewear and everyday styles. I think that it was a bit too aggressive in trying to expand beyond its core customer base. And we just saw its CEO in the most recent conference call saying they're going to be a lot more efficient in identifying new trends and being more dedicated in their spend on kind of ramping up new brands. And so a lot of people jumped onto the -3% comps in North America. That certainly is something to keep an eye on, but it's not quite as bad as other publicly traded peers like Nike or Under Armour. I think Lululemon is a great brand that's got a great customer following, and this might be an opportunity to buy it while it's at historic lows.
Yeah, my son is, it was traditionally a women's brand. And at least in my generation, a guy would not go near something that was known, for making women's tights. But it's become like the cool thing for guys to wear Lulu stuff also, which is pretty cool, I guess. Certainly cool for the company. So yeah, it's a proven brand. So fingers crossed for Lululemon. I'm going to go with a kind of a warning. Let me bring this guy up. In other words, a company that I'm not buying and that I would be afraid of buying. It's called Open Door. Open Door is a meme stock. It's basically a sort of a house flipper, this iBuying, instant buying of properties. You buy, sometimes you fix it up and then you sell it fairly quickly. I think on average, they own a property for 90 days. A friend of mine, George Noble, has turned me on to this company in a sense of alerting me to the dangers of this. You've got a lot of retail money in this stock. One of the leading proponents has been going to the house of a musician in Toronto called Drake. And I'm probably showing out my ignorance, right? Because maybe everybody else knows Drake, but I know him a little bit. But and with these signs saying, please promote Open Door, Drake. And that alone should be kind of a red flag, right? I mean, if your stock is dependent on a random musician, or if that's like a major factor in your stock's performance, it's probably not going up for the right reasons. So, if you're watching this, if you're an Open Door fan, if you're in this Open Door army, God bless you. I'm not against you. I'm just saying this stock is a lot riskier than people think. Zillow has failed at this model, as I understand already. I know Open Door is trying to shift to like a platform model where they're not actually holding the inventory, but that's tough, right? That there's not a lot of competitive advantage in this space. There's criticism now, like, are they, because they book the wholesale of the house as their revenue, and then they take out the cost and their gross profits. I mean, maybe that's fair if they're a flipper, but as they move more to a service business, do they have revenue recognition issues? They've twice paid fines, $39 million, because they misled securities investors about AI pricing capabilities, and $62 million to home sellers because it misled them about pricing info. Also, they issued a bunch of convertible debt that converts at a lot lower then the $8 stock price is like $1.57. So if that debt converts, you've got whatever the stock price is minus $1.57 worth of dilution per every single share. So it's just my warning to the holders of Open Door that you might, the party may come to an end at some point. So with that, I'll move on. I am getting some questions from the audience. I got a bunch of them actually. So hold tight, guys, and we'll wrap this up with some questions. First question is from how should investors balance near-term enthusiasm with the long-term competitive dynamics among AMD, NVIDIA, and other chip makers? Kind of sounds like the person is asking, what's the best play for the long run, or is there a short-term bubble among these chip makers? Something like that. Either of you guys have a thought?
Yeah, I mean, both of those are concurrently true at the same time. This is a bubble, and it's going to continue for a while too. The valuations don't make any sense, in my opinion. I think that this is beyond the comfort level that I have as an investor to only invest in AI companies when you see these ridiculous valuations. At least in my opinion, they're very inflated. But on the other hand, James, it's going to continue for a while. I mean, OpenAI is in the middle of a $40 billion funding round right now. They just raised $8.3 billion just earlier this month, and it was 5 times oversubscribed. It had 5 times more people that wanted to invest at its $500 billion valuation to give this company more money to deploy for the data centers than it even took. And it took money from Andreessen Horowitz and some other really big name, very prominent investors, which means it's having no problem raising capital in the markets right now. And of course, it's going to continue to spend that through partnerships and with deals with AMD and NVIDIA and all the stuff we talked about in the data center. So is it in bubble? Yes. Is this going to continue for quite some time? I think so.
I think the way to think about it is position sizing. That if you are worried about it being a bubble, and let's be honest about it, a bubble means big bull market, right? So that, you hear a lot about George Soros, but one of the things that he is most famous for saying is you buy the bubble. So you want to be long, but it's not about that you have to be 100% long. There are other things you can buy. And you want to buy things that are relatively cheap as well. I think the worst thing you can do is not be invested. You need to have a position. You need to be in the market, because sitting on the sideline with cash, you're certainly losing money.
So true. I mean, true if you have your skill, Owen. I mean, I think a lot of people would be afraid of getting out, of not timing their exit correctly. And that's always the fear, right? Everybody wants to participate in the upside of the bubble, but nobody wants the downside of the bubble when it bursts. But if you can, to some degree, do that, you win, right? It's just for me, I'm always been scared, and maybe I'm too stodgy, maybe I'm too conservative, and I've probably missed a lot of good returns that way. But I'm glad we have you on board, because you're a fantastic thinker, and you share you're unabashedly a timer, and I think a lot of people aren't willing to say that.
Well, just think, for me, it's really simple. What would have to happen for this massive bull market to end? Well, you can kind of predict what it will look like, because we have what is effectively NVIDIA doing vendor financing. So we have AMD doing vendor financing. They are literally selling OpenAI chips, or promising to provide them with chips. And OpenAI does not have the revenue to buy them. Now, you're making a bet that OpenAI will have the revenue to buy them. Now, Oracle said that it was going to provide $300 billion worth of compute for OpenAI, and OpenAI's total revenue is $60 billion. So those are funny numbers, and they are predicated, 100% predicated, on OpenAI actually achieving its revenue. Now, that makes it a really easy metric to monitor, because at some stage we're going to get to a point where, instead of people saying we're going to build a 5 gigawatt, 10 gigawatt, 20 gigawatt, and that's only now. What happens when they come out a year from now and they say it's a 50 gigawatt data center or a 100 gigawatt data center? We're talking about real money now. When we get to those kinds of numbers, it's going to be even more money. Well, at some point in the future, it's going to disappoint. And it's not going to say, we're going to jump it by 10x again. We're going to jump it by 10x again. We're going to jump it by 10x again. They're going to say, you know what? Instead, actually, we're going to grow it by 1x. Or we're not going to spend as much money next year. Or we're pulling back our spending on infrastructure. And when that starts to happen, then you have to really watch the shares. Because if they start rolling over on that, the chances are that's probably the top.
So you've got criteria, basically, and it's not, you go into this with your eyes open. You go into this with specific things that you're watching for that signal it's time to get out, which is, I think, a lot better than most people do. We've got a few more quickies. We can bang them out.
I have some comments on this.
Go ahead, Simon. Go ahead.
I don't know if it's too late in the program to open up a whole new can of worms that I'm going to anyway.
It sounds controversial, so bring it on.
This has to plateau. To Owen's point, you cannot continue the growth rates that we've seen over the last couple of years.
Yeah, the Earth will become one big data center if it keeps growing at this rate.
There's 700 million GPT users, right? If you get 10x from that, that's every user in the planet is using GPT now. It's just not going to, and then you can't have another 10x. Right? It's just going to plateau. And you've seen the killer use case right now. The way that companies are making money off of this, there's 5 million users that are paying for GPT today. They're $200 a month that they're paying for. And where is that going? How do you justify that financially? You're replacing a full-time equivalent employee with GPT. You're hiring AI agents to do the job. They used to pay a salary and health benefits to a human being for $200 a month for access to an AI agent to do the same work. That's going to necessarily plateau. And you're seeing companies laying off tens of thousands of employees for the last couple of years. At some point, that's going to have to plateau, and we're going to have to turn the spigot from cost savings, operational efficiency to revenue generating with AI at the pilot helm. I don't think anyone knows what that's going to look like yet. We're all assuming it's going to maintain the same trajectory it has. But in my opinion, it's going to be a much, much tougher slog, and we see a plateau in the next couple of years.
A wise point. And by the way, Curia, we also pay $200 a month for ChatGPT. I think it's excellent that what you say, that yes, in the beginning it can replace the work of analysts, but ideally it just lets an analyst do a lot more and drive more value. We haven't totally cracked that, not we as a species or as a planet yet, but that will be hopefully the next evolution of this AI. So two more quick questions. We got Laura asks, what opportunities and risks should individual investors consider when evaluating exposure to private equity? I think, Owen, you got something better to say. My quick thought would be, look at the numbers. It's not sexy. There was a cachet for a long time about private equity, about alternatives. Like, it was cool. You know, you were doing something that only the really rich people could do, or you know, only the family offices. The returns, depending on whose study you look at, are maybe a little bit better than the public markets, but maybe not. And especially right now, we're probably in one of those maybe not periods. So I wouldn't be jumping into private equity right now. If you have some specific information on some specific deal and you have a specific in on that, and you really have good information, maybe. Okay. But aside from that, I wouldn't just rush in just because it says private equity. Owen, do you have anything on top of that?
I think it's really easy. If the share is going up, the chances are they've got something good. If the share is going down, it's not because it's undervalued. It's because they do not have a good company that they have bought. So I would simply bet on performance, and I would not bet on underperformance.
Interesting. For kind of a free market efficiency answer, like the market you believe is fairly reflecting what's going on with these PE firms right now.
Yes.
Yeah. Awesome. All right. Final question. Megan says, as the U.S. seeks to reduce reliance on imported uranium and develop domestic fuel supplies, where do the best investment opportunities lie across uranium mining, enrichment, and advancement reactor technologies? Any of you guys want to take that one?
Sure. Like you said, there are three topics. The USA imports 90% of its uranium fuel. Now, the fuel is not the uranium. This is refined fuel, the stuff that actually goes into the reactor. And there's only two companies in the USA do it. So I would look at Centrus, which is LEU. Mm-hmm. That's the new name for the old USEC. So that was the Uranium Securities Company. That was the refiner of fuel for the U.S. Army's nuclear power plants during the Cold War. It had a fantastic valuation back in the last big uranium bull market in 2006 and 7, and then it crashed and almost went bust. So the chances are now that if we are going to go more nationalistic in sourcing uranium fuel, then that company has to scale up. It has to also build the refining capacity for high assay, low enriched uranium, which is 20%. Your conventional nuclear reactor is 3% enriched. 20% enriched is for small modular reactors. If we're going to have small modular reactors, we need to build the fuel manufacturing capacity to put into them. So that, to me at least, is a very easy way to invest.
Got it.
If
And
you,
SMRs, for those who knew, that they're not like here yet, but maybe within several years, Bill Gates thinks within 5 years, they'll be producing power, and they're just a lot smaller and a lot less fuss. Oh, and you were going to say something. Maybe I cut you off.
well, small modular reactors are kind of like plug and play. And
Yeah.
so, and then we need to know, are they going to be efficient? Are we going to get the same economies of scale? Because China built their first small modular reactor, and it was the most expensive reactor they ever built. So the whole business model that is being proposed around small modular reactors is that they can achieve economies of scale, that it might be expensive to build one, but if you build 20, then it turns into a much cheaper prospect. We're not at that scale yet. And then think about all the planning you have to do. You've got to go to every different municipality. You've got to make sure that they will all accept your small modular reactor. So we need total reform of planning to get that done.
Yep.
But
Especially in a states' rights country like the U.S. Yeah.
so that to me tells me that the bigger story is nationalization, or I guess more national priority to build our own domestic manufacturing
Yep.
capacity. That is much more important than the small modular reactors. If you're looking at uranium as a commodity, the USA is not the only country that mines it. Kazatomprom in Kazakhstan is the largest producer of uranium in the world. They crashed the price because they did not want small miners succeeding. And that was why we had such a big bear market. Now they want higher prices. Kimiko in Canada wants higher prices. But we have certainly got the potential for uranium to do well as a vehicle for nuclear. But that is going to be more volatile because it's a commodity, because it is mined in lots of different countries. And there's no shortage of mines for uranium. It's about the question of demand for the metal.
On that note, Owen, very, very, very good insight on that. Thank you guys so much for joining us. Owen Treacy of Fuller Treacy Money and Simon Erickson of Seven Investing. It's always a pleasure to speak to you on this live stream. I learn something new every single time, and I hope you guys watching at home do. So, guys, thanks again for doing this. And thanks to you guys for watching us at home.